My name is Jeff Driver, General Manager, Business Development and Investor Relations for Australian Foundation Investment Company. I have with me today Mark Freeman, the CEO and Managing Director, and David Grace, the Portfolio Manager responsible within the team for Australian Foundation Investment Company. Mark, we've just announced the financial year results for 2022. What did you see as the key features of that particular result?
Well, it was a very strong year for profit growth. The underlying profit was up 53% to $360 million. But if we exclude one-off items, the profit was up 45% to $285 million. The increase in profit was driven by higher dividends received from the companies we invest in following a recovery in the economy and higher iron ore prices. The earnings per share was up to 23.3 cents and the dividend was maintained at 24 cents per share. Importantly, the MER, which is the management expense ratio, was still very low at 0.16%.
Thanks, Mark. David, the portfolio performance for the year was slightly behind the index, but still ahead, I guess, over the three and longer term, slightly ahead in the longer term periods. What did you see as the major impact or the reasons behind the portfolio performance for the year?
Yeah, thanks, Jeff. So two main reasons for that. The first is our overweight to quality growth companies, which underperformed over the course of the last 12 months. Many of these businesses have got to full valuations at the end of last calendar year and have fallen in the recent 6-month period. But these are companies that we think have really strong long-term prospects and companies we think will outperform over our long-term time frame. So that's that 3 to 5 years, as you mentioned. And companies like CSL, Reece, ARB and James Hardie. And the second reason was our underweight to the resources sector. So in our view, there were two temporary reasons as to why the resources sector was particularly strong in the last 12 months. And the first of those was the rolling off of stimulus payments. And then the second one was the Russian invasion of Ukraine, where there was fears of shortage of commodities, and we saw all commodity sectors really rally quite strongly. As interest rates have risen in recent times, we've seen the resources sector pull back quite sharply, which has been helpful for our portfolio performance.
Dave, it was a very volatile market for the year, very strong first half of the year and then a very volatile market in the second half of the year. How did you look to manage the portfolio during that period, particularly the second half of the period here?
Yeah, thanks, Jeff. So the volatility we've seen is as volatile as we've seen for a long period of time, and it doesn't change the way that we manage the portfolio. We're still heavily focused on quality companies that can deliver meaningful earnings growth over the long term, and we seek to own them in a meaningful way so we can benefit from the compounding returns that these companies typically deliver. During the year, the main additions to the portfolio were new investments in JB Hi-Fi, Mirvac and WiseTech, being a growth company. And in a tough consumer environment, you may say, why buy consumer stocks at the moment? But we've seen both JB Hi-Fi and Mirvac fall quite materially in recent times, and both companies are now yielding close to 5%, so we feel really comfortable we're buying them at a discount with strong income supporting our investment. On the sales side, we exited our holdings in Cube Holdings and Endeavour Group. And we also lost Sydney Airport and Milton Corporation, which were acquired throughout the year. But most of the transactions really were adding to existing holdings in the portfolio and using the recent pullback in share prices to add to our holdings at what we view as attractive prices with good long-term earnings growth.
Thanks, David. So Mark, as we've alluded to, it was a volatile period, as everyone knows. What are your sort of thoughts of the coming 12 months for the market? How do you sort of see it sort of playing out?
Yeah, well, as a long-term investor, Jeff, it's very hard to predict short-term movements in markets. We don't try and do that, but we were cautious coming in, I guess, at the end of the first half of the year. The markets were very strong, valuations were elevated, and then that piece played out as David talked to. The market came off quite a lot, first with the growth stocks and then the resource stocks. So we were actually thinking we were starting to see some fairer value in the market, not bullish, but some fairer value in some prices, particularly around or towards the end of June. There's been a bit of a bounce back since then, but looking forward, we still have concerns around the inflation and the interest rate piece. Central banks globally are going to keep putting up interest rates. We're seeing some of that impact come through, particularly overseas, on the consumer spending piece. So although we saw better prices, better value in the market, we're still a little bit cautious. We're not jumping in yet, and the US market still looks a little bit high to us. So, but you know, as we normally do, we look for opportunities, and you know, nervousness and fear brings better value and better opportunities. So we might get some of that in the second half of the year. But we as per usual, we want to make sure in good companies, and we look through our portfolio and we're very happy with the quality of the businesses we've got and their ability to withstand what might be some difficult economic conditions.
Mark and David, thanks for joining us today.
Okay, thanks,
Thanks, Jeff.